Welcome to a very special episode of Markets in Minutes. I am your host from the MacroMicro research team, and today we're diving deep into our comprehensive guide for the second half of 2025, focusing on 10 critical charts that will help investors navigate what promises to be a complex landscape of trade tensions, technological transformation, and market turbulence. Markets continue to reach new highs amid the taco trade rally, even as they've grown less reactive to tariff developments. But here is the crucial question we need to address today. Have tariffs truly had no material impact on the broader economy or corporate earnings? The answer, as we'll explore, is more nuanced than the headlines suggest. Looking ahead to the second half of 2025, we're seeing three key market drivers emerge: slowing growth, persistent inflation, and evolving rate expectations. Drawing from our extensive research and the engagement patterns we see on our platform, we've identified 10 charts that are absolutely critical for understanding this dynamic landscape. These charts are organized around four key thematic pillars: Trump's tariff strategy, manufacturing dynamics, macroeconomic stability, and the AI and semiconductor boom. Let me start by setting the stage. We've compiled these 10 charts into a single, dynamic collection that you can save to your dashboards for real-time tracking and instant access. But more importantly, these charts tell a story, one of both opportunity and caution in equal measure. Let's begin with the elephant in the room: tariffs. They remain the defining issue for 2025, but our position has consistently been that the most extreme measures are behind us. Here is why this matters for your investment strategy. Trump's tariff agenda operates as targeted leverage, primarily aimed at three strategic objectives containing China's tech influence, preventing trade rerouting, and strengthening the US negotiating position. The 100% plus tariff rates on Chinese goods that we saw earlier this year represent what we believe was peak escalation, designed to force compliance rather than serve as sustained policy. Going forward, we expect more measured tariff implementation, focused on specific sectors and strategic concessions. This strategic moderation stems from both political and economic realities. Trump's approval ratings show clear sensitivity to economic disruption, and the 2026 midterms create very real accountability pressure. What is particularly telling is what we're hearing in corporate earnings. Businesses are adapting to tariff realities without the catastrophic impacts that were initially feared. Perhaps most importantly, inflation has remained contained despite tariff implementation, which validates our view that extreme tariffs were temporary pressure tactics rather than permanent policy. The investment implication here is clear. Tariff uncertainty peaked in the first half of 2025, with policy clarity and moderation emerging in the second half. Let me walk you through our first two critical charts. The US-China tariff rates chart shows us that Chinese tariff rates exceeding 100% earlier this year marked peak trade tension. We anticipate stabilization around 60 to 80% rates as Trump shifts from maximum pressure to negotiated settlements. A flattening or decline in these rates in the second half of 2025 would confirm our thesis of strategic moderation. Our second chart tracks mentions of keywords in S&P 500 earnings calls capturing corporate America's sentiment as businesses navigate tariff pressures. In the second half of 2025, tariff-related mentions are likely to taper as policy clarity emerges. But layoff concerns may linger if manufacturing weakens. A continued drop in inflation mentions would reinforce market confidence, supporting valuations, particularly in tech-heavy indices. Now, let's turn to manufacturing, where we're seeing a unique challenge unfold. The manufacturing sector is confronting a natural cyclical downturn that is intersecting with tariff-induced supply chain disruption. The sector's performance will ultimately determine whether Trump's trade strategy succeeds without triggering broader economic deterioration. Here is our key insight. This convergence is manageable due to disciplined inventory management and AI-driven demand offsetting traditional manufacturing weakness. Global trade volumes reveal significant front-loading activity as companies accelerated shipments ahead of tariff implementation. However, and this is crucial, current inventory indicators remain controlled. PMI inventory subcomponents and US industry inventory to sales ratios show no dangerous buildup, suggesting manufacturers maintain discipline despite trade pressures. This inventory restraint prevents the excess accumulation that typically amplifies manufacturing downturns. The key dynamic for the second half of 2025 is whether consumer demand absorbs the front-loaded inventory without triggering destocking pressure. The sector's ability to navigate this cycle without triggering broader economic stress depends on whether lean inventory management can be maintained as the natural cyclical downturn continues. Our third chart, tracking global manufacturing inventory trends, monitors the balance between incoming demand and production buildup in key economies. When new orders exceed inventory accumulation, showing positive readings, it suggests healthy demand absorption. Current readings indicate manufacturers have avoided dangerous inventory buildups despite front-loading activity. Sustained positive readings in the second half of 2025 would confirm that genuine demand is absorbing artificial trade flows, supporting manufacturing stability. Chart number 4 is our proprietary World Manufacturing Cycle Index, which integrates global manufacturing, retail, and trade data to gauge production cycle health. Currently trending downward, it signals a slowdown exacerbated by tariff-induced trade disruptions. However, the index's fluctuations around zero suggest a resilient downswing rather than collapse. If it stabilizes in the second half of 2025, supported by sustained consumer demand, manufacturing could avoid active destocking, bolstering global equities. A sustained drop below zero would signal deeper risks requiring defensive positioning. This brings us to one of the most fascinating aspects of the current environment: price stability. Despite the theoretical inflationary impact of tariffs, recent data shows inflation remains well contained. With energy prices now the main source of uncertainty, core PCE has held steady even after new tariffs, signaling that inflation fears may have already peaked. This supports a more accommodative policy backdrop going forward, which is crucial for market stability. Oil prices serve as both an inflation driver and a geopolitical barometer. Recent Middle East tensions demonstrated how quickly energy markets can shift from fundamental-driven pricing to risk premium volatility. Current oil stability around $65 per barrel, combined with high base effects in the first half of 2025, suggests limited upward pressure. Using the Taylor rule, if oil remains at $65, the Fed retains room for 225 basis point cuts. At $75, space for 1 to 2 cuts remains, aligning with recent Fed guidance. However, any spike above $80 sustained through the second half of 2025 would materially constrain Fed flexibility and potentially reignite broader inflation concerns. Our fifth chart tracks NYMEX WTI crude oil futures prices. Oil is currently in what we call the safe zone, around $65. High base effects in the first half of 2025 and stable inventories suggest limited upward pressure. Sustained trading below $75 in the second half of 2025 would maintain the disinflationary backdrop, supporting Fed accommodation. Chart 6 focuses on the US Cleveland Fed inflation nowcast. For PCE, the Fed's preferred inflation gauge has dropped to 2.3%, with CPI at 2.4%. Continued moderation toward the Fed's 2% target supports the case for rate cuts. If PCE remains below 2.5% through the second half of 2025, it validates our thesis that tariff-induced inflation remains manageable. However, if PCE rises above 3% and sustains those levels, it would signal tariff pass-through exceeding Fed tolerance, potentially forcing policy tightening despite growth concerns. The combination of labor market resilience and central bank accommodation provides crucial economic buffers against trade policy shocks. The labor market's continued stability represents the most important buffer against trade policy risks. Despite corporate earnings calls highlighting tariff concerns, actual employment data shows stability. Initial jobless claims remain within normal ranges, and job creation continues at a moderate but sustainable pace, providing consumers with spending power to absorb higher prices from tariffs without triggering demand destruction. Central bank positioning has evolved to provide policy flexibility. The Federal Reserve's measured approach, combined with coordinated accommodation from global central banks, creates a monetary backdrop that can respond quickly if trade tensions escalate. Market. Implied rate curves suggest investors expect this accommodative stance to continue, providing liquidity support for both economic activity and financial market stability. Our seventh chart tracks the US and Eurozone policy rate curves, implied by interest rate futures. Markets currently signal 50 basis points of Fed rate cuts in the second half of 2025, with similar expectations for ECB accommodation. This dovish outlook reflects confidence that inflation will stay contained despite tariff pressures and continues to support risk asset valuations. Chart 8 is our global central bank monitor, which tracks easing trends across major central banks in 2025 amid tariff-driven disinflation abroad. Currently, over 77% of central banks are cutting rates, signaling a globally coordinated easing cycle that continues to provide critical liquidity support to markets. Finally, we come to what may be the most important theme of all: the AI revolution and its impact on semiconductors. Artificial intelligence demand continues to drive semiconductor performance, creating a powerful counter-narrative to manufacturing cycle concerns. While traditional manufacturing faces cyclical and policy headwinds, the AI-driven semiconductor boom represents structural growth that increasingly dominates both economic performance and market valuations. The semiconductor sector demonstrates exceptional inventory management, with major companies maintaining inventory days near historical lows despite aggressive production ramps. This reflects robust and sustainable AI-driven demand that contrasts sharply with cyclical demand patterns affecting other manufacturing sectors. The AI infrastructure build-out represents a multi-year investment cycle that is somewhat insulated from trade policy concerns, creating a growth engine that can sustain broader economic momentum. For investors, semiconductor inventory management serves as a real-time gauge of AI demand sustainability. Continued inventory efficiency suggests this technological transformation maintains economic momentum, providing crucial support for corporate earnings and broader growth. Our ninth chart tracks major semiconductor companies' days inventory on a year-over-year basis, showing us inventory efficiency in the industry that is driving global growth. Low inventory days, even with aggressive production ramps, signal robust demand and lean supply chains. Stable or declining inventory days in the second half of 2025 will confirm sustained AI demand, supporting tech-heavy indices and export-driven economies. A spike in inventory days could signal demand weakness, pressuring tech valuations and broader market leadership. Our final chart, number 10, compares Taiwan exports year-over-year with the MSCI ACWI Index. Taiwan's export data offers a window into global trade momentum and AI-driven demand, particularly important as the island produces roughly 90% of the world's most advanced semiconductors, largely via TSMC. Historically, Taiwan's export growth has led MSCI ACWI downturns by 6 to 12 months, making it a reliable early signal. Any sustained slowdown in exports during the second half of 2025 could serve as a leading indicator of broader equity market pullbacks. Continued strength in AI-related ICT exports, despite flat traditional electronics, would confirm the structural nature of the AI boom, supporting Taiwan's equity markets and validating the technology sector's premium valuations. The second half of 2025 presents investors with an unprecedented convergence of policy extremism, cyclical transitions, and structural transformation. Success requires moving beyond headline noise to focus on fundamental data that reveals how these forces interact within the real economy. Our 10 chart framework offers a clear roadmap for navigating this complex environment. Trump's tariff strategy appears designed for maximum leverage without triggering broad economic damage. Manufacturing cycles show resilience, not recession. Inflation remains contained, and labor markets continue to anchor macro stability. This backdrop allows central banks to maintain a coordinated easing stance, supporting market liquidity. Meanwhile, the AI boom remains a powerful driver of long-term structural growth. Rather than fearing policy uncertainty, focus on the economic adaptation mechanisms these charts reveal. Markets historically reward those who distinguish between temporary policy volatility and fundamental economic deterioration. In the second half of 2025, these 10 charts provide that essential distinction, enabling investment decisions based on economic reality rather than political rhetoric. Now, before we wrap up, I want to let you know that these 10 charts we've discussed today are just a glimpse of what is available in our comprehensive 2025 Key Data Dashboard. This powerful resource features 30 essential indicators designed specifically to help you track trade dynamics, technology trends, and broader economic developments. If you want to dive deeper and gain access to the full suite of analytical tools we use in our research, head over to MacroMicro to redeem your exclusive dashboard access and stay ahead of the curve. The key takeaway is this: we're not looking at a crisis, but rather a complex recalibration. The fundamentals remain supportive, the adaptation mechanisms are working, and the structural growth drivers, particularly in AI and semiconductors, continue to provide economic momentum. For investors willing to look beyond the noise and focus on the data, this environment presents significant opportunities. That concludes our special edition of Markets in Minutes, giving you the 10 critical charts for navigating the second half of 2025. As always, stay focused on the fundamentals, watch the data, and remember that in times of uncertainty, disciplined analysis trumps emotional reaction every time.